So this is part number 33 of this multi-part video series for positional stock traders. And in this video, I want to discuss the importance of looking at moving averages on the daily time frame chart before taking a trade on the weekly time frame chart. And this we have already discussed in terms of technicals. So just because a stock sets up on the weekly time frame chart with a base and a pivot point doesn't mean that you have to buy. You have to look at comparatives. You have to look at moving averages on the daily chart because we are following the basic Mark Minervini trend template criteria, which says that the 50-day moving average should be above the 150-day and the 150-day should be above the 200-day. That's the basic criteria. Doesn't matter whether you take a trade on a weekly or a daily time frame chart. So this is an old chart. As per the regulations, we are using old charts to discuss stocks. So this is 14th of November 2022. You can see that's a cup. So after this bar, there are three bars consecutively which are below the high of this candle. So the high of this candle becomes the pivot point, and that's a cup marked by Market Smith on the Market Smith chart. Now you could say the base starts from here, but no, the base starts from here. This is a weekly chart, and if Market Smith is marking it as a cup, the base actually starts from here. So we simply follow what is available on the Market Smith chart. We don't go into details. Very simple. Just keep the system simple. Okay. So 75.55. So let's draw the pivot range. So 75.55. This is okay. Then you have this is 5% above that. 75.55 multiplied by 1.05. I have a calculator here, 79.32. So that's the buying range. Let's draw the selling range. So this is 75.55 multiplied by 1.20, 90.66. And this is 75.55 multiplied by 1.25, 94.43. And let's give it green color. Okay, so that's the green color. Next, let's draw the, wait, let me check. 90.66, 75.55 multiplied by 94.43, correct. Let's draw the stop loss range. So this is 75.55 multiplied by 0.92, 69.50. And this is 75.55 multiplied by 0.95, 71.77. Okay, so that's the buying range, selling range, stop loss range. And look what happens. See, on Monday itself, you get an opportunity to buy. The Monday stock shoots up 20% in a single day. Okay. Then in the same week, it touches the selling zone. So in the same week, Monday, I think you buy on Monday, and by Tuesday, Wednesday, you're already in the selling zone. You get an opportunity to sell. Look what happens. So you have enough time. Look what happens before it begins to consolidate. Right? So within a week, you get an opportunity to sell partial position, and within 2 weeks, you're completely out of the stock. So when the stock is pushing through the blue zone, see this what happens is very powerful breakout, right? You have to buy all your shares in that blue zone. When it enters that green zone, you get an opportunity to sell. So maybe you sell 1/4 of your position, maybe you sell 1/3, Maybe you sell half, whatever, and you keep the remaining shares if you want to track this 10-week simple moving average. Very powerful breakout. Going back to the prior breakout, three red bars inside the base, all three are low volume, right? Do you see tight price action inside the base? Look at these two bars, very, very tight price action inside the base. Do you see smaller spreads inside the base? Yes. Smaller spread means the distance between high and low of the bar is small, okay, relatively small compared to other candles on the chart. So smaller spreads, low volume down closing, tight closing within the base, ideal. And this is base number 2, by the way. And look what happens Monday, Tuesday, Wednesday. Monday, Tuesday, Wednesday, you are done with the trade. You get an opportunity to buy, you get an opportunity to sell, partial position. Look at the volume. See, on Wednesday itself, it has crossed 3 times average weekly volume. This happens. It's a very powerful breakout. But in a moment, I will teach you why you should not have bought this stock. Okay. Next. Okay. So it goes up. Now let's go to the next phase, next base. So we just saw this base. Okay. From this, the stock shot up. It went up. Okay. After that, it forms another base. This is base number 3. That's a cup with handle. So if you look at this, that's a cup with handle, correct? And that's the pivot point, right? So let me remove that first. Yeah. So we saw this breakout and we saw this base. This is base number 2. This is base number 3. Okay. So now that becomes your pivot point, the high of this candle. What's the high of that candle? Which is 133.28. So let's do that. Okay, let me select this. So 133.28. So this is 133 and this is 133.28 multiplied by 1.05. That's 139.94. 139.94. So that's the pivot range. Then we'll adjust the stop loss range. So 133.28 multiplied by 0.92, 122.61. Okay. Then 133.28 multiplied by 0.95, that is 126.61. Stop loss range adjusted, then this one 133.28 multiplied by 1.20, that's 159.93. Then 133.28 multiplied by 1.25, that's 166.6. Look, now you have the stop loss range, everything. Let's see what happens on Monday. Monday, Tuesday, Wednesday, Thursday. So Thursday you get an opportunity to buy. Will you buy? Of course you will buy. That's a cup with handle. Base number 3. And by the way, in this base, the relative strength of the stock was clearly above 80. I think here it was 82, 83. Here it must have been 87. I forgot exactly what it was. But will you buy on Thursday? Of course. Look at the volume. The volume has already gone past uh, twice the average weekly volume, that too on Thursday, right? Let me repeat that. So Monday, Tuesday, Wednesday, Thursday. So Thursday you end up buying all of your shares because the price is going, probably would have gone out of the blue zone. So if you plan to buy 100 shares, you pick up all 100 because volume has already almost double the average weekly volume. Let's look at Friday. Friday it closes inside the pivot. Friday it closes above the pivot, right? Or inside the blue zone. What does that mean? Remember uh, How to Make Money in Stocks, written by William O'Neill, 4th edition book, chapter number 11, page number 261. He says that The true winners do not close below the pivot point, right? And true winners do not generally go more than 8% below the correct pivot buy point. If you remember those two statements, you will notice that it's a powerful breakout. Then see what happens next week. Continues to go up. That's it. Wait 1 week, wait another week, you are done. You're selling. The stock has already pierced your selling range. Have a look at this volume. 19 million. What's the average volume? 3 million, 3.85 million. So you do get an opportunity to sell here. Sometimes you might not even get an opportunity to sell because the stock runs up so fast. Let me show you how did it run so fast. So let's look at next week, okay? Monday, Tuesday, Wednesday, Thursday, Friday. Okay, Friday is gone. The stock is above the blue shaded area. You already have your 100 shares. Has the stock closed below the pivot? No. That means, is it showing signs of a winner? Yes. By the way, have a look at this base. Look at all the red bars inside the base. How many red bars inside the base have high volume? Only a single red bar, right? Rest all the red bars inside the base have low volume. What does that mean? Low volume down closing. The base is dominated by low volume down closing. That's a clear sign of institutional accumulation. The institutions are snatching the shares away from the retail players. Next week, that's it. Monday itself, you get an opportunity to sell. And in case on Monday you're not in front of the screen, okay, and you miss this selling range, you get a very pleasant surprise, right? The stock has already crossed the green zone. In such case, what would you do? In such case, you would probably lighten up your position. You get a much favorable price, maybe sell 50% or one third or one fourth or whatever, and keep the remaining shares as long as the stock remains above the 10-week simple moving average because it is sloping up. Or if you want to take more risk and you see a window on a weekly chart, which is very rare, if you want to take more risk, just let it run. Don't even think of selling, partial selling or whatever. Or you could choose to move your stop loss from here to somewhere inside the green zone. So even if the stock reverses, you end up booking 20-25% based on what is your average execution price inside the blue shaded area. Okay. Listen to what I said in the last 1 minute again and again and again. Rewind this video and keep listening to it again and again and again until you understand what I'm saying. There are some things that I'm saying very fast. These are trade management things. It is just coming naturally to me. So you have to rewind and listen again. Okay. That's Monday. Tuesday, Wednesday, Thursday, Friday. That's it. In Friday, it finally gives you a closing inside the green zone. So there could be some traders who might want to wait till the week ends because by the time the week ends, the stock could, go up more than another 20% during that week above the green zone. I'm talking 20% above the green zone. Okay. Could happen in a week's time. But as you can see here, although this is a green bar means up closing, but it is up closing, but it is weak closing. Weak closing means the closing is below the midpoint of the bar. Weak closing on high volume, that's a negative sign, correct? Window is a positive sign. So you are getting mixed signals. Window is a bullish signal and high volume weak closing is a bearish signal. So when you get mixed signals, you sell half, right? So both of these bases were successful. Let me move the price a little bit forward. I think I have the chart. Yeah. So this base has been very successful. Stock shot up like from here. Stock shot up like 90%. And then from this base, from here till about here, the stock shot up another 50%, 90% plus another 50%. And both the cases, the stock was the relative strength of the stock was more than 80. Right? Very, very powerful strategy by William O'Neill. This is not my strategy. This is William O'Neill's strategy. By the way, do you notice another base here? See, after this, you have one, two, three bars closing below the high of this base. I mean, It's easy to spot bases here. I mean, you don't need to do base counting here. It's all visual, right? Now coming to the main point of the video. Why did I make this video? I help you understand that both these bases have worked, but you should have taken this trade, not this trade. Because see, on 19th of November, this is 21st November breakout. On 21 November 2022, if I go to the daily chart, this is a daily chart, okay, 21 November 2022. Yeah, this is 21 November 2022. Look at this breakout, okay. The blue is above the red and the red is above the green, which means the Mark Minervini trend template criteria is not satisfied here. Okay. So the 50-day moving average is above the 200-day and the 200-day is above the 150-day. So we have a blue, red, green combination on 21st of November. Okay. So I would have definitely rejected the stock because I don't want to violate the trend template criteria. So I want blue, green, red. I don't want blue, red, green. Okay. I'm very strict with that criteria. However, in the next breakout, when this handle was, this is a daily chart. So when this handle was broken on this day, okay, on on this day, okay, when the handle was broken here, you would have bought somewhere in this range, okay, because the 5%, the 5% starts in this above this pivot point, right? So you would have bought the stock in this range. Look at blue, green, red, okay, and the stock shot up. So which base is more risky? This base gave you 90% return. This base gave you 57% return. Just because this base gave you 90% return doesn't mean that this base was a good base than this base. This base was a risky base and this base was a less risky base. And our goal is to take a, wait, let me drink some water. Our goal is to take a less risky trade. Okay. In this case, although you got a good return, but in practical real life situation, I would not have taken that trade. Here, I would have definitely taken that trade. And you notice stock never closed below the pivot point on the weekly chart. It's a very, very important point to notice. William O'Neill does not mention on page number 261 of his book whether the closing should be below the pivot on a daily chart or a weekly chart. I am assuming he's talking about the weekly. He says that true leading stocks or true winners don't close below the correct pivot buy point, and true winners don't go more than 8% below the buy point. Those are the two statements that I have studied very carefully. In that statement, he does not talk about daily or weekly time frame. I am assuming he's talking about weekly. Anyways, on the weekly time frame chart, the stock never, as you can see here, the stock never closed. If you see the closing of this is the closing of this bar is 133.67 and the pivot point is 133.28. So the closing was above the pivot point. So you understand. So true winning stocks don't close below the pivot point. We can safely assume that he's talking about the weekly chart. He will wait for a weekly close. Okay. On this bar, if you wait for a weekly close, you do get a selling opportunity. But during the week, you could have sold the stock at a much higher price. Moreover, if you had bought this, definitely you would have taken more risk. And carefully notice in while this breakout is before this breakout, the closing price was above the moving average. So the closing here is 111.21 and the moving average is 109.51. So before the breakout, previous week, the price was above the 10-week simple moving average. Here, before the breakout, previous week, the price is below the 10-week simple moving average. So what is the closing here? 69.25 and the simple moving average is 68.88. Of course, the closing was above the 10-week simple moving average. But notice that this closing and this closing, this one looks better. Okay, this, and by the way, this is a 1, 2, 3, 4, 5, 6, 7 week cup base. It's not cup with handle, it's a cup base. A cup is more risky than a cup with handle because in a handle you get more consolidation, right? It's a 7 week base. This is not a 7 week base. This is at least like 3 4 months. This story is going on, right? So this is a much longer, wider base. This is a very short base. So this base is less risky than this base, and that was indicated to us by the moving averages on the daily chart. So the daily chart moving averages also tell us which base is more risky, which base is less risky. So now you understand which trade to take, which trade not to take. And by the way, if you had bought this base, you would have sold here all your shares because this is a closing below the 10-week simple moving average, although it's a low volume close. Low volume close are not a big deal, but still, you lost significant amount of money on that week. That is 12% on low volume. I normally look for a high volume close below the 10-week simple moving average. So even if you didn't sell here, you would have had to sit through a lot of pain for many months. Okay. So compare that trade management to here. Okay. Here the stock continues to comfortably trade above the 10-week simple moving average in spite of the fact that it has gone up like 57%. You understand what I'm saying? So you must understand as a professional which base is risky, which base is not risky. And that can be determined by looking at price and volume. It can be determined by looking at moving averages on the daily time frame chart. It can be determined based on the length of the base. It can be determined by looking at the closing price of the week compared to the moving average. It can be determined by looking at the volume also. So there are so many things that you can check. So that is why I continue to tell my students, look at the chart visually. Do not automate things. Do not waste your time in automating the system that I am teaching to you. Spend that same time reading William O'Neill's book. You are writing fine script 10 things, and all of that is not required. Coding is not required. Let's say you are a software programmer. Okay. To be a good software programmer, you don't need to be a good cook. Okay. Or to be a good runner, you don't need to be a good cook. Okay. So that skill is not required. Similarly, for a trader, it's not required for you to be a good coder or a good software programmer. To be a good trader, you just have to look at the stock visually and determine whether it is worth your time, whether it is worth your money or not. So the time that you're spending writing a code or a Pine script, you are wasting time. Okay, you will lose your intuition, you will lose your creativity if you spend time doing programming. When you look at stocks directly, when you look at 1000 charts, your all coding happens here. Okay, all your programming happens in your brain, and your brain is very powerful than whatever Pine script you are writing. Okay. So stop all of that nonsense. It is not required. Just focus on the chart, just focus on price, just focus on volume. Remove all your indicators, your RSI, the MACD, stochastics. We don't need all of that. Okay. Just look at price, just look at volume, just look at moving average on the weekly and the daily time frame chart. Just count the number of uh, count the number of weeks inside the base. Look at the type of the base pattern which is mentioned by Market Smith. Look at the pivot point. Pay attention to volume as the price is breaking out of the pivot point. Do partial selling. Keep some shares as long as the stock remains above the 10-week simple moving average. Ensure that the stock is fundamentally strong. You are done. Okay, that's it. You don't need to do anything else. For this, whatever I told you, you don't need any programming or anything. Okay, you just have to understand the chart properly. Okay, thank you so much.